Hello, I'm Shain Vernier.
Hi, I'm Connor Woods.
And I'm Nick Quinn. We are the analyst team here at howtotrade.com. And together we're going to show you everything that you need to know about trading the bear flag. So let's get started. A bear flag is a continuation pattern, and it signals the extension of an already existing downtrend after a pause in the price action. As patterns go, they tend to form in the middle areas of existing downtrends, and they're very common in all markets. They're also very, very easy to integrate into any of your trading strategies. So let's have a quick look at exactly how we'd go about identifying it. So remember that the bear flag is showing us price consolidation within the context of the downtrend. So what we're looking for to qualify the pattern is we're looking for quite a sharp move into that consolidation. Once we've got that sharp move, that's going to make up the first portion of the pattern, which is the pole. From here, we're looking for price to begin to consolidate. And in its classical sense, we're looking for it to create a diagonal structure like the market is attempting to reverse before it then fails and moves to the downside. Now, what we would want to do there is we would want to look for the sharp move down to comprise the pole section of the flag, and then we'd be looking to join the support points to create the layer of support trend structure underneath, and then the trend line above our resistance, which would create the shape of our flag. Now, you look to trade this to the downside, but just a key point to remember is that in its classical sense, when we do get a diagonal lean on the flag portion, they do take longer to play out than if that structure was to be horizontal. So you can sometimes find them, and the actual prices, they tend to be a bit more horizontal. Those patterns, those flagpole patterns, they tend to play out much faster to the downside. So that's just a key point to bear in mind when you're looking at flags on a chart. But that is the classical way that we would go about identifying it.
Now then, let's have a look at the example. The great thing about bear flag patterns is they are quite easy to identify, and all we need to do first of all is identify that trend. So we need to find that bear market trend, that series of lower lows and lower highs, and we can see we've got that here on this market now. Now after that, we want to identify the flag part of the formation. So we want to identify the flagpole and the actual flag, and the flag is just a period of price consolidation. So if I get my drawings up on the chart now, you can see we've got this flagpole coming down, and that's our flagpole, that's our initial move down. Then we've got that price consolidation here, and that's the portion of our flag. So we just need to draw those trend lines matching up those lows and those highs. Now how we actually would trade this is potentially we wait for that breakout candle below that portion of the flag, which is an indication to us that the market wants to go lower. So essentially traders may take a short position once the candle breaks below this level here. And generally speaking, stop losses would be just above the flag, and you can see that this particular trade would have got a really nice 2.81 risk reward ratio in no time at all. And that's how we can use those bear flag patterns in trading.
Okay, let's take a look at a few of the pros and cons for the bear flag pattern. On the pro side of the ledger, the pattern is easy to identify. Also, it's one of the most reliable continuation patterns in all of technical analysis. Lastly, it occurs frequently on all time frames and all markets, so it's never hard to find a bear flag pattern. Now, on the cons side, it can produce false signals. In flat or choppy markets, the bear flag can prove ineffective. Also, large flags pose a significant risk. So, the larger the range of your flag, theoretically, the greater your risk. Your stop loss will be much larger. And lastly, it's not as reliable on shorter time frames. So, if you're looking at trading bear flag patterns on 1 minute or 5 minute charts, you may want to at least reduce your leverage to account for the reduced efficacy of the pattern. Now, let's review some of the key takeaways from the bearish flag pattern. Number one, the bearish flag pattern suggests downtrend extension. It is considered to be a bearish continuation pattern. Number two, a bearish flag consists of a flagpole and the flag. The flagpole is a pronounced downward movement in price. The flag is a period of sideways price action that occurs immediately after the flagpole. Number three, bear flags are ideal for trading downtrends. To do so, a sell order is placed beneath the flag and a stop loss order is placed above the flag. Number four, the chart pattern can produce false signals and has a reduced efficacy on shorter time frames. So if you're trading it on shorter time frames, be careful with the bear flag. Now, if you want to learn more about the bearish flag pattern, be sure to check out the How to Trade Trading Academy inside our trading room. There, you'll find a longer form tutorial where we'll show you how to fit the bear flag into your own trading methodology. We'll then demonstrate how to take that plan and trade it against real market price action. You'll have everything you need to practice and gain experience. And once you're ready, feel free to join our How to Trade Funded Trader program.